What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to go over everything you need to do, very important stuff before the end of 2023. So if you're watching this video, there's very few things left to take advantage of taxes, lowering your taxable income and gains, and of course, making sure that you don't fall into the potential challenges with wash sales. We're going to talk all about it. As always, if you enjoy this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. And the first most important thing that you should be doing before the end of this year is joining our Discord and our Patreon and enrolling in our courses if you want to, because the sale will go away and it will end after December 31st. So that's number one. The first thing on the to-do list to do before the year end is to check out with the links down below. And definitely do use the coupon code Santa Rally if you want to take advantage of that 70% discount on the bundle and 16% annual discount that's available until the end of this year for the Patreon and the Discord. So the first thing on the list is going to be maxing out your tax advantaged accounts. Yes, these are your 401ks, your Roth IRAs, and your HSAs, everything that is going to allow you to, and these are both taxable, tax advantage and taxable accounts. So 401k is a taxable brokerage account, which of course you can contribute to with your pre-tax dollars, along with your employer's sort of matching that limit as well. But if let's say that you are deferring your payments, in other words, let's say that you are, $9,000, $10,000, whatever you make, and you are only contributing a small percentage of that. And by the end of this year, hopefully by now, you've contributed a lot in your employer's 401k, but there's still a limit of $22,500. That's how much you can invest in your 401k. That's the cap for 2023. So if you're over 50 years old, you're eligible to a contribution of additional $7,500, making $30,000 total cap on the contribution in the 401ks. So make sure that you do max that out as much as you can, so you're taking advantage of the opportunity that 401k offers. Same thing is true with annual Roth IRAs. So basically, Roth IRAs are tax-free retirement accounts. In other words, you are investing with your post-tax dollars, and everything that grows within the Roth IRA grows for tax-free, right? That's the beauty of Roth IRA. The only, of course, setback is that you can't withdraw until I think 62 and a half is the age, or might be 65. I just have to double check, but it's after your retirement you can start withdrawing tax-free. But everything that grows within the Roth IRA grows tax-free. So this is a tax advantage account, which definitely take advantage. So every year you get a limit. Every year it's also raised. So $6,500 per person is the limit on your Roth IRA. So definitely do contribute as much as you can. If you can max out that limit, great. If you can't, definitely do as much as you can, because everything that grows in a Roth IRA is, of course, tax-free. Same thing is true with the HSA. That's your health savings account that lets you save and pay for qualified medical expenses with the tax-free dollars. So there are limits to how much you can contribute each year. Over contributing can lead to unexpected tax penalties, so you want to make sure that you are within the limit. And for 2023, for single self coverage is $33,850 and $7,750 for family coverages as well. Those above 55 years old can contribute an additional $1,000 for catch-up contribution as well. And of course, 2024, they're going to raise those limits to $4,150, and for families, $8,300, and 55 and over can contribute another $1,000. So definitely do take advantage of that. Again, there's only 3 or 4 more days left in 2023, so you want to make sure that you are on top of this, because starting January 1st, these caps are going to reset back to zero, and you're going to have to do it all over again. So if you haven't already maxed out your 401ks, your HSAs, your 529 savings plan, or your Roth IRAs, most certainly consider doing that, because these are, again, very important tax advantaged and taxable, of course, accounts that help you grow your wealth over time. It's just going to be a waste if you don't really max them out. So 2 more things I want to mention in this video that I think are going to be super important. I'm going to keep it nice and short. The first one is, the first thing you want to consider is long-term versus short-term capital gains. So if you are holding on to, let's say, any stocks, any positions that are on the long-term sort of path, but they haven't really crossed that threshold, you may want to delay, or you may want to consider foregoing selling that stock until next year if it crosses that 1-year threshold, right? So for example, if you bought a stock, let's say in February of this year, and you have made some very good money in 2023, right? So waiting just another 30 to 60 days, so February of next year, is if let's say that you decide to take profits and sell, that's when that 1 year period is going to basically elapse, and then as a result it's going to be coming under the long-term capital gains versus short-term gains, which obviously the tax rates are significantly different if you are paying short-term capital gain versus long-term. So you may want to consider delaying your profitable positions and selling them until you cross that threshold of that 1 year mark, so that it's considered under long-term gains. The opposite of this is also true. So if you're holding on to any losing positions that you may want to use for tax loss harvesting. So again, it's a concept in investing that we understand and utilize almost every day, every year. And that simply means that you can offset all your gains for the year by the amount of losses you realize. And of course, that's called tax loss harvesting. So if you have any losing positions that you don't really believe are going to recover or don't really have a lot of conviction in, you can sell for a loss. Of course, consider that, and of course, do your due diligence. Of course, speak with a financial advisor, qualified financial advisor. I'm not one. I'm not your financial advisor, so definitely do your due diligence and of course research on this. But consider selling some losing positions, which can of course offset some of those gains, and as a result, your taxable gain is going to be significantly lower. In fact, sometimes you can even break even and not have to pay taxes on those gains at all, because you're offsetting those by the losses that you realized in the previous year. So those are, and of course, if your losses kind of grow, they're a lot, then you can roll them over several years out. You can roll them over and of course take them in the next year. There's also limits to how much you can roll over and how much you can actually realize, and of course offset your gains with. So definitely do consider these strategies. These are super important before the end of this year, maxing out your accounts, and of course at the same time making sure that you're rebalancing your portfolio to best suit and fit with your investing strategies and needs. And of course, definitely speak with a financial planner, advisor, to kind of make sure that you're on the path to achieving your goals. Because at the end of the day, like when it comes to personal finance and investing, and this is covered in more detail in our psychology course, it is really just two things: where you are and where you're trying to go. That's it. Where you are and where do you want to go. Okay? If you don't know where you want to go, that's the first step. Like, you need to figure out where do you want to go, and that's in terms of financial fulfillment. Like, what's that number where you will feel comfortable retiring and not having to work any day for the rest of your life, right? What's that number? That number needs to be figured out by understanding your expenses, understanding your lifestyle, understanding the type of experiences you want to have with your friends, with your family, with your future significant other, whatever it is. That is where that planning comes into play. Figure out a budget, figure out an expense list, and then figure out what that number is in the future. Where do you want to go? Now that you have that number, then you work backwards, right? So once you have that goal, once you have that number in mind, then you work backwards and then understand, okay, this is how much I have, this is where I want to go, and this is in the amount of time I want to get there, whether it's 10, 20, 30 years. And then of course, all you have to do is figure out how much returns you need to make on a compounded basis every single year to get to your goal. And all of that, everything else, is part of the overall planning, which is every year maxing out your tax advantage accounts, taxable accounts, and of course contributing as much as you can, saving and investing as much as you can, and generating some good returns so you can get to your goal. But hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like, and hopefully this is a little bit valuable. Always subscribe to the channel. Links to our Discord, Patreon is going to be down below. And happy investing, and I'll see you all in the next video.